The committee will come to order. Members are asked to take their seats. Without objection, the chair is authorized to declare recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing is entitled Oversight of the U.S. Securities and Exchange Commission. I now recognize myself for 3.5 minutes to give an opening statement. I think we all know that the SEC has a well-established 3-part mission to include investor protection, the maintenance of fair, orderly, and efficient markets, and the promotion of capital formation. Unfortunately, in the recent past, this latter aspect of the mission has received short shrift. That's why I'm very grateful to Chairman Clayton for his leadership in devoting more time and attention to the capital formation mission. And although our economy is clearly red hot today, there are some worrisome signs that we must confront. Number one, as recently as 2016, entrepreneurship, the provision of startups, reached a 40-year low. We know that IPOs have been on a slide downward, although we've seen a gradual uptick. They are half of what they were 20 years ago. And although we passed a bipartisan banking bill, it is largely a community bank, credit union, and regional banking bill, when 80% of our business debt comes from investors in our capital markets, not from lending officers in our banks. Small business represents 99% of all business enterprises and half of our U.S. jobs. Surely they are the job engine of America. And when companies do go public, unfortunately, many are withering on the vine. And so we have a number of challenges. If these businesses cannot find adequate capital, it begs the question, where will the Amazons, the Googles, and the Apples of tomorrow come from? How can we sustain long-term 3% GDP growth without ensuring that we have plenty of these startups in the pipeline? It also begs the question, how will we successfully compete with China, particularly Made in China 2025, unless we infuse more reforms into our capital markets, because we know China is committed to dominating several different fields in high tech, including high tech, biotech, and artificial intelligence. And we know they have a very healthy IPO market and currently produce about roughly a third of the world's IPOs that I think we would much prefer to have in America. And another question that we have to ask ourselves and ask the SEC, how can Main Street investors have more opportunities to invest in their future? How can they invest in great companies when we look at our IPO market and see that so many of our public companies are now older, they're bigger, they're fewer? And when they go to the public markets, this is often at a $1 billion valuation when so much of the explosive growth took place as a private company that they were not allowed to invest in. Why was it only the wealthy that managed to invest on these companies on the way up and not our teachers, our barbers, our farmers, and our first responders? We too must act. And we have an opportunity, since we know the Senate will be voting on a package of capital formation bills. Historically, this is something that has been done on a bipartisan basis in this committee. I note again, when President Obama signed the first Jobs 1.0 Act into law, he said it was an important step on the journey to remove barriers of capital formation for entrepreneurs. That job must continue, both at the SEC and Congress, and I look forward to hearing from our witness on the capital formation agenda of the SEC. I now turn to the ranking member for an opening statement for 3 minutes.
Thank you very much, Mr. Chairman, and welcome back, Chairman Clayton. Mr. Chairman, given recent developments regarding the Volcker Rule, I'd like to offer a reminder that Congress put the Volcker Rule into effect in order to stop banks from essentially gambling with taxpayer dollars. But earlier this year, the Office of the Comptroller of Currency, the Federal Reserve Board, the Federal Deposit Insurance Corporation, and the Commodity Futures Trading Commission, and the Securities and Exchange Commission issued a proposal that appears to give banks a pass and allow them to continue what Congress clearly wanted to stop. Now, the SEC's analysis of the proposed rules said, and I quote, "We recognize that the proposed amendment would increase moral hazard risk related to proprietary trading by allowing dealers to take positions that are economically equivalent to positions they could have taken in the absence of the 2013 final rule," end quote. So I'm wondering why the SEC would be supporting changes to the Volcker Rule that will increase moral hazard risk. I'm also concerned about the SEC's regulation-based interests. In Dodd-Frank, Congress specifically gave the SEC the authority to impose a harmonized fiduciary standard for both brokers and investment advisors. But the SEC's proposal does not do that. So I'm going to urge Chairman Clayton to ensure that the SEC's final rules protect investors and retirement savers from unscrupulous actors. So, Mr. Chairman, it has been reported that you have a plan to advance a package of capital markets bills to the House floor. You and I have not talked about this, have not been consulted on what might be included in such a package. But based on some of the bills the committee has marked up to date, I remain concerned that this package may contain bills that could weaken investor protection, given that any such legislation could make the SEC's job that much harder. So I am looking forward to Chairman Clayton's ability to express his concerns to this committee about any measures that he views as potentially harmful to investors, and I look forward to hearing from him throughout this process. So I thank you, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, the chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and well, Mr. Chairman Clayton, finally our economy is starting to fire on all cylinders, and while tax reform is strengthening our economy, increasing paychecks, it's also starting to deliver real results for hardworking middle-income families, not only in West Michigan, but across the country. I had an opportunity to meet with a number of NFIB members from Michigan yesterday, and they echoed that sentiment. But moving forward, it's my goal to build on the success of tax reform by continuing to promote policies that empower taxpayers, strengthen our economy, and provide more opportunity for American taxpayers to succeed. Signed into law, the Economic Growth, Regulatory Relief, and Consumer Protection Act has begun to provide much-needed relief to consumers and small businesses on Main Street, but that's just the beginning of unleashing American innovation, jobs, and capital while supporting economic growth. We can all acknowledge that the United States has the strongest, deepest, most liquid markets in the world, but it's becoming more apparent that our capital markets are becoming less and less attractive as well to growing businesses due to the one-size-fits-all securities regulations currently in place. For public companies, some of which are just a couple of $100 million, up to a number of massive companies knocking on the door of $1 trillion in value. Our capital markets are the envy of the world, but we have to keep it that way. We must jumpstart our capital markets to truly unleash American innovation and economic growth and provide greater investment opportunities for Mr. and Mrs. 401k. So, Chairman Clayton, as we can work together, we can further our economy by building on the successes of the Bipartisan Jobs Act. Let's work together to reverse the negative decline in public companies by modernizing our nation's securities regulatory structure to ensure the free flow of capital, job creation, and economic growth. I appreciate that.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you. Thank you so much, Mr. Chairman, and welcome, Chairman Clayton. The SEC has been very active since you were here last October. In April, the Commission proposed a best interest rule for brokers who are giving recommendations to retail investors. We've known for a long time that retail investors do not distinguish between advice they get from investment advisors who are already subject to the Fiduciary Rule and sales recommendations they get from brokers. so a best interest rule for brokers was long overdue. I have to say I was somewhat disappointed that the SEC did not propose a uniform best interest standard for both investment advisors and brokers who are providing recommendations to retail investors. A uniform standard is exactly what the SEC staff recommended after conducting a lengthy study of this issue in 2011. And I'm concerned that the SEC's proposed best rule is not as strong as it should have been, and is not as strong as the Department of Labor's fiduciary duty rule, so I look forward to hearing from Chairman Clayton on this. The SEC has also been quite active on cryptocurrencies and limited coin offerings. I think the SEC is right to be active in this space because there's a great number of retail investors who are getting hurt in cryptocurrencies. And as Chairman Clayton has acknowledged, a lot of the digital tokens that have been issued in ICOs are in reality unregistered securities. I also look forward to hearing what the SEC is seeking to clarify the loan rule. My time is up. I look forward to your testimony. I yield back. Thank you.
Gentlelady yields back. Today, we welcome back to the committee for his second appearance before us, the Honorable Jay Clayton, Chairman of the U.S. Securities and Exchange Commission. He received a more thorough introduction in his first appearance, so in the interest of time, we won't say it again. Chairman Clayton, you are just recognized now for 5 minutes to give an oral presentation of your testimony. Again, welcome.
Chairman Hensarling, Ranking Member Waters, members of the committee, thank you for the opportunity to testify before you today about the work of the SEC. I will attempt to be brief in my opening remarks and refer you to my written testimony, which details our work over the past year. On behalf of my fellow commissioners and the 4,500 women and men at the SEC, I'd like to thank this committee for its support. Congress's recent fiscal year 18 funding for the agency is enabling the SEC to make significant investments in furtherance of our efforts to modernize our information technology infrastructure, including improving our cybersecurity risk profile. Further, congressional funding, including our current...
Excuse me, Chairman Clayton, can you pull the microphone a little bit closer to you, please?
You want to hear me?
Thank you.
Further, congressional funding, including our current pending fiscal year 19 requests, will allow us to hire experienced staff to improve our expertise relating to our markets, cybersecurity, capital formation, and protecting Main Street investors. We recognize the vote of confidence that Congress has shown in the SEC, and I am committed to ensuring that the agency is a prudent steward of our appropriations, and I know the SEC staff is committed to our mission. With regard to agency operations, I believe that the agency is running effectively. This is in large part due to the efforts of our senior leadership in our divisions and offices, including our 11 regional offices and their respective teams. We have many good teams at the SEC. My written testimony outlines many of our accomplishments over the past year, particularly as they relate to the long-term interests of our Main Street investors, including improving our standards of conduct for investment professionals, the integrity of our markets, and overall investor protection. Additionally, I am pleased that the Commission will meet next Thursday to adopt final amendments to the smaller reporting company definition, which will expand the number of public issuers eligible to provide scaled disclosure. I also want to bring to your attention the discussion of cybersecurity in my written testimony, including the discussion of our 2016 Edgar intrusion. The testimony discusses the ongoing internal review of this matter that is being conducted by our Office of General Counsel, including the remedial steps we are taking. Finally, I want to leave you with this. The women and men of the SEC are working hard each and every day, motivated by the fact that tens of millions of Americans are invested in our securities markets for the long term. The accomplishments detailed in my written testimony are because of the individual and collective efforts of these members of our SEC team. In closing, I would like to again thank the committee for its continued support of the SEC, its mission, and its people. I look forward to answering any questions you may have.
Chair now yields to himself for questioning. Chairman Clayton, you heard my opening statement. Again, as you well know, there has been a 20-year decline in IPOs. We have roughly half the companies going public than we did 20 years ago. How big a problem is this, and what investment opportunities are Main Street investors losing out on?
Okay, so I think you broke that into two perspectives, both of which are important. The first is from a capital formation perspective. Are we impeding capital formation by not having as attractive a market for companies? I think the answer to that is yes. Are there alternatives in the private markets? Yes. But our public capital markets have been an incredible engine for capital formation in America, incredible competitive advantage. We want to keep that. The second part of your question, does it trouble me that the suite of opportunities that's available to ordinary investors is shrinking on a relative basis because our public capital markets are shrinking on a relative basis? Yes, it troubles me. And I do believe that the quality of opportunities that you see in the public capital market space is not as good as the quality opportunities that are available to people with a great deal of capital in the private market space.
In your opening statement, you mentioned that you've noticed an open meeting, I guess, for Thursday, June 28th, to include a number of items on smaller company reporting. Will there be any discussion of 404B of Sarbanes-Oxley at that time?
Yes, there will be. I expect there will be. The smaller reporting company thresholds are something we're going to be examining, providing more public companies with the opportunity to use scaled disclosure. There are thresholds for when 404B is applicable, when companies have to comply with it. I believe those thresholds should be examined, and I expect a discussion of that at our meeting.
Well, I must admit, when I meet with a lot of entrepreneurs, venture capital, startups, what I typically, and I asked the question, I just recently came back from a trip to Silicon Valley, and one of the things I heard when I asked, have you considered going public? And one pithy answer was, it costs too much and it's too big of a hassle. And of all the cost factors from particularly early growth stage companies is 404B of Sarbanes-Oxley. So looking at that on-ramp is something I would commend that you do. And speaking of commendations, the Treasury Department has 15 different policy recommendations in the capital formation space that the Commission has yet to act on. So again, I applaud you for what you're doing. I kind of wish it might be at a little quicker pace. I know, as you know, this committee has voted on a number of provisions, as has the full House, some of which the SEC could do on its own authority, including providing greater clarity for angel investors and updating the definition of accredited investor. How important is that that we do that, and what is the Commission contemplating at the moment?
Okay. So in the registered space, the public capital...
Again, if you could draw the microphone a little closer.
In the registered space, in the public capital market space, I believe in the process that Jobs Act is, I think as you referred to it, Jobs Act 1.0 started, which is, one size fits all doesn't make sense for our public companies. We have some at the top of the spectrum, which are, incredibly sized companies. 200x, 300x the size of some of our small and medium-sized public companies. We are looking at that path provided by the Jobs Act in order to provide scaled disclosure, scaled requirements. Let me go back to your conversation with Silicon Valley. At what point is a company big enough where going public makes sense? Right now, I think that point is too high. on average. If you have,
Increasingly, it's $1 billion, isn't
if
it?
you have to get to $1 billion for it to make sense to access our public capital markets, that's probably too high. In the private space, in particular, I think what you're focused on is the private offering space that would be available to accredited investors. Or we are looking at the accredited investor definition. I believe it needs to be modernized.
My time has expired. I now recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. I have a question that I would like to propose, but before I do that, since you mentioned Silicon Valley, I too was there recently, and I was appalled at the lack of diversity. I know that there are a number of organizations, civil rights organizations, that have been working very hard to increase participation of minorities and women in the Silicon Valley businesses. They have not done very well, and of course, I would be anxious to be of assistance to them in making sure that we could reduce the cost and reduce the hassle of becoming IPOs, but we certainly must take into consideration whether or not these companies are developing, understanding that some of us are going to be focused on diversity in those companies. Having said that, let me go to my question on fiduciary. As we have discussed before, I'm concerned that the SEC's proposed regulation best interest does apply a fiduciary standard to brokers that effectively function as investment advisors by providing retail investors with personalized investment recommendations. The best way to protect investors and reduce confusion is to treat all advisors, regardless of their titles, the same under a fiduciary standard that requires them to put their clients' interests first. Yet the proposal would only prohibit brokers from calling themselves advisor and fails to address the numerous other titles that may be used, like financial planner or wealth manager. Don't you agree that it would be far simpler and clearer for investors to subject any broker that holds himself out as providing investment advice or who engages in advisory services to the advisors act fiduciary duty and require them to put their clients' interests first?
Thank you. Thank you for raising the question of our proposal to bring clarity to the broker-dealer space and the investment advisor space. If you'll indulge me, I'll explain what we're doing. There are two relationship models for retail investor advice in America. There is an investment advisor model and a broker-dealer model. The investment advisor model is a portfolio-based, holistic model where you come to me, I'm your investment advisor, and I say, tell me what your goals are, education, retirement, what your risk tolerance is. I'm going to help you go over your whole portfolio, monitor it, plan it, and I'm going to charge you a fee for doing that. The fees vary, the types of fees vary, but I'm going to charge you a fee. It may be we can go into that in more detail. A broker-dealer model is you come to me for a recommendation in a specific area on an episodic basis. You say, Jay, I'd like to get some exposure to telecom stocks and maybe some international stocks. I make you a recommendation. That's the relationship there. What we are doing, in each case, I can't put my interests ahead of yours. We are bringing to the broker-dealer space that requirement. We're also bringing to the broker-dealer space care obligations, that in getting to the stocks that I will recommend to you, I have to go through a series of steps that ensure that those are right for you and your circumstances. That is what we're doing in the broker space. But more importantly, the conversation that I just had with you through our Form CRS, our Client Relationship Summary, the customer needs to understand what I'm doing in wearing either hat, how I'm getting paid, and what my other incentives are. And most importantly, we're going to bring clarity to that space. So you raised a very good point. Does the customer know how I'm getting paid and what my motivations are and how I'm mitigating the conflicts that creates? There is no conflict-free relationship. There are conflicts in an investment advisor relationship, and there are conflicts in a broker-dealer relationship. Disclosing them, mitigating them, making sure that everybody understands what the motivations are, that's what we're going to do in this space. Or I should say, that's what I want to do in this space.
I appreciate that, and I'd like to continue my conversation, my discussions with you on best interest, the client, the customer's best interest always being put first. I think we need to continue that conversation.
I'm very happy to, but I want the American people to understand that in the investment advisor space, the investment advisor fiduciary duty, the way that is applied is you as the advisor can't put your interests ahead of the customer.
That's right.
And that's what we're going to do in the broker-dealer space. You as the broker-dealer can't put your interests ahead of the customer. So I look forward to, we have a long comment period. I want to keep talking.
All right, thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and welcome again, Chairman Clayton. You know, we were starting to talk about this, or at least I was in my opening statement a little bit about how the SEC needs to take a path to make complex, obscure, outdated rules more relevant for today's investors and for our capital markets. I can't emphasize enough how strongly we need to do this. Many would argue we've got a digital, fast-paced capital markets, but we're dealing with analog and paper-based regulations, and we need to catch up. And one of those, I do want to say thank you for, to take a quick moment, is your recent proposed rule on what's commonly referred to as the loan rule, which was issued May 2nd. And this is the type of thing that I think will be helpful for us to do that. It'll help clarify what for a long time has been a source of ambiguity and uncertainty in capital markets. So thank you for that. I do want to touch on Kokesh and disgorgement. Last month, the SEC's Division of Enforcement co-directors testified in front of the committee that, actually the Capital Markets Subcommittee, that the SEC has been unable to recover $800 million in disgorgement since the Supreme Court's Kokesh decision. In your testimony, you stated, quote, allowing clever fraudsters to keep their ill-gotten gains at the expense of our Main Street investors, particularly those with fewer savings and more to lose, is inconsistent with basic fairness and undermines the confidence that our capital markets are fair, efficient, and provide Americans with opportunities for a better future, close quote. Well, since the Kokesh decision, many have called for extending the statute of limitations assigned to disgorgement, while others have said that giving the SEC the authority to pursue restitution would be counter to the SEC's core mission. And I'd like to hear from you, what do you believe Congress should be considering as we are looking at addressing the Kokesh issue?
Thank you. And I think you described it very well. The Supreme Court in Kokesh determined that disgorgement was a penalty. Therefore, the 5-year statute of limitations that applies to penalties applies to disgorgement remedies. I believe in statutes of limitations. I think they serve a very important role. What does bother me about that decision from a practical point of view is the most well-concealed frauds may fall outside of that limitations period. And I think the SEC should be in the business of getting money back for investors who are subject to that kind of fraud, a Ponzi scheme, and whatnot. And a possible way to do that is to give us restitution authority in those circumstances. Let me be very direct. I think we should have the authority to get people back their money in those cases. I do think we should bring cases quickly. Statute of limitations, drive you to bring cases quickly. But in these very well-concealed situations, we should be able to get people their money back.
Well, I look forward to working with you on that because I know I want to ensure that the SEC has the necessary tools to protect those shareholders and investors. Let's talk briefly about capital markets modernization. As I mentioned in my opening statement, we do have the strongest, deepest, most liquid markets and envy of the world, but that's been slipping. We know that. Today's equity markets have been shaped by 1975 amendments to the Securities Exchange Act, which goes back to the 1930s. But obviously, markets have dramatically changed over the last 40 years. Do you believe that the one-size-fits-all approach to securities regulation is a competitive disadvantage to the United States as compared to our global competitors?
So we have benefited greatly from our capital markets. We have 4.4% of the world's population. We have over 50% of the world's largest public companies. I mean, it's pretty amazing. That's largely because of our ability to create capital formation in our public capital markets. When I meet my regulatory brethren from around the world, they would like to replicate what we have. That is their goal. Now, look, capital formation around the world is good for all of us, but in the U.S.,
We want it here.
we want to keep this going.
Yeah. So we know that there are some things that are working well. What areas do you think we can improve?
I do think we can improve the requirements, the public company requirements, particularly of our smaller and medium-sized companies to have access to capital. The rules that we have today are the product of history, just as you said. They're not if we sat down this afternoon, all of us, and tried to write rules, that they would be different from the rules on the books because life has changed a great deal. Our Division of Corporation Finance has that perspective, and they're looking at recommending changes. We will have a release coming that cleans up a lot, but we need to continually do this.
I look forward to working with you. Thanks, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you. Chairman Clayton, the last time you were here, I asked you whether the SEC's pilot program on access fees charged by exchanges was going to include a zero rebate bucket. And you did mention that you were going to include a zero bucket, and thank you very much for that. And my question is, when do you expect to finalize the access fee program? This year, this summer, this fall, this winter? When?
Well, we are going through the Administrative Procedures Act process. We've proposed the rule. It's out for comment. I believe that comment period is coming to an end rather quickly. It is on my near-term agenda. If I had to sit here today, I would say sometime this fall.
Thank you. Thank you. And as you know, last month, Bloomberg reported on a very troubling meeting that one of your colleagues, Commissioner Pivovar, had with Citigroup. And in the wake of the Parkland shootings, Citi had just announced a new policy on guns, in which Citi stated that it will require all the retailers that it does business with to adopt best practices on gun sales, such as limiting gun sales to people who are over 21 and have passed a background check, and not selling so-called bump stocks. I think that Citi's new policy is very responsible, a very responsible decision, and they weren't the only bank to do so. Bank of America also announced that it would restrict its business with gun manufacturers that make military-style guns for civilian use. But Commissioner Pivovar was apparently upset with Citi's new policy on guns when he met with a group of their executives in April. And according to a press report in Bloomberg, Commissioner Pivovar, quote, castigated the Citi executives for, quote, straying into social policy, end quote. The report also stated that he issued a thinly veiled threat to Citi, saying that their new gun policy would cause them to lose votes on SEC rules that Citi supported, even though the SEC has absolutely no role in setting firearms policy in the United States. My question is, do you think it was appropriate for Commissioner Pivovar to use his position at the SEC to try to influence a private company's policies on firearms, or any private policy that doesn't affect the SEC?
So I'm not going to comment on the subject matter of those press reports. In a separate hearing over on the Senate side, this was raised, and the question of whether there should be an Inspector General's inquiry was raised, and I'm going to leave it at that.
Okay. Okay, then let me ask you, since we're not talking about PVR now, but would you base your vote on the SEC rulemaking on whether the companies that support the rule do business with gun manufacturers?
I'll tell you what perspective.
That's not part of an IG report.
No, and I'll tell you what perspective I bring to this job, which is, we have our mission. I pursue all of our rulemaking. We're all human beings. I hope I pursue all of our rulemaking, and I pursue all of our enforcement cases with the idea of what's in the long-term interests of the people who put money in our market and leave it there. And that's the perspective I bring.
And social policy would not influence you. It's the markets and your job.
Yeah.
Thank you. The question also, I'd like a clarification on your proposed best interest rule for broker-dealers. The SEC proposed a rule that says a broker can't put his own financial interests ahead of the interest of the retail customer, end quote. The proposed rule then goes on to imply that a broker will satisfy this obligation as long as the broker's interests aren't, quote, the predominant motivating factor behind the recommendations, end quote. Is this your intent? Do you really mean to equate these two things? In other words, under the proposed rule, as long as a broker's own interest wasn't the predominant motivating factor behind a recommendation, does that mean the broker automatically did not put his own interest ahead of his customers?
So I think you're taking that language. Let me be clear on what we are proposing. The broker cannot put their interests ahead of the customers. I believe that language is a recognition of the fact that there is no conflict-free advice model. But we are absolutely clear that the broker can't put their financial or other interests ahead of the client's.
Thank you.
Time of the gentlelady has expired. And Mr. Chairman, if you could continue to pull that microphone a little bit closer to you, please. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Chairman Clayton, thanks for being here today. Last week I sent a letter to you and other financial regulators outlining my concerns over guidance being treated by examiners as rules or creating binding obligation on financial firms. This practice is fairly prolific in the banking space, but I'm not sure your agency is immune from the trend. Essentially, examiners are treating guidance as rule without subjecting anything to the process outlined in the congressional review process. Are you willing to communicate to your staff that, in the words of the Federal Reserve Chairman Jay Powell and Vice Chairman Randy Quarles, that rules are rules and guidance are guidance?
I think that articulates my view of rules and guidance pretty well.
Well, I know that, in my discussion with Vice Chairman Quarles about the letter he was receiving, and I assume you received yours, he wants to be the individual who tries to bring all the regulatory agencies together to sort of have a common way of going about issuing guidance, even to the point of having a disclaimer in the guidance that says this is guidance, this is not a rule, and therefore punitive action will not be taken if you do not adhere to this guidance, because it is a suggestion, it's not a rule. And as we've seen with the past administration, especially with the CFPB, whenever they produce guidance, they suddenly believe that they've got the authority to enforce that as a rule. And it's very concerning to me. I don't know that your agency does a lot of it, but I'm sure there is some. And so that's my reason for my concern this morning, and hope that you'll be willing to join us in this effort to try and clear up for your examiners to be able to know what is rules and what are guidance, and appropriately adhere to those.
I very much agree with clarity in that area, and I very much agree with our system, which is to get to rules, you've got to go through a process, and guidance is guidance.
Thank you for that. Also, I've spent a lot of time working on issues surrounding data security in this last several months here, and breach notification. Along those lines, I'm concerned about the government's hypocrisy in setting standards for cybersecurity readiness and disclosure. The SEC intrusion that occurred in 2016, which you described in your testimony, written testimony, wasn't publicly disclosed until the fall of 2017, shortly after you got there. The SEC itself holds self-regulatory organizations, SROs, to an immediate standard for disclosure of cybersecurity incidents under Regulation SCI. Public companies are held to a materiality standard for disclosure. My question is, should the SEC and other federal agencies be held to the same standard which they hold with regard to supervised entities and SROs?
The short answer to that question is, based on my experience at the agency and with other agencies, I don't think it should be the same standard. There are governmental considerations that would go into whether to make a disclosure or not. Do the same principles apply? When we decided to disclose our cyber incident, was it on my mind that the American people should know and that they should know what we're doing about it? Absolutely. But I could see other circumstances, maybe not at the SEC, but at other agencies, where national security and other considerations weighed against immediate disclosure. So I don't want to say, certainly for other agencies, or make a blanket statement that the exact same standard should apply. But should we be thinking about, what I consider our shareholders, the American people, as we disclose what happens? Absolutely. And that's the approach that we took when we disclosed the cyber incident.
Well, I know that the OGC is doing an internal review of the incident, and they're not done yet, according to your testimony this morning. So we don't have some answers there. But I'm very concerned. We've discussed this before. It took a year for this disclosure to happen. And I understand national security interests. I understand that law enforcement may want to try and find a way to track down the guys or gals or entities, whoever they are, that are trying to break in and do nefarious things here. But at the same time, as you just disclosed, you're the keeper of the private data of our citizens. And the last time we talked about this, my question to you was, did you feel that the markets were manipulated by this event of people getting into your data? And your response was, we're not sure. I don't think so. Quite frankly, Chairman, that answer is not good enough, and we've got to improve on that. And I'm hopeful that the report will give you the kind of guidance it takes to make sure this doesn't happen again. And if it does, that there could be a more timely disclosure of this incident, so that the people can take their own actions to protect themselves, or that businesses can take their own actions to protect themselves if the data is disclosed. I yield back. Thank you.
I agree.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Clayton, welcome.
Thank you.
Puerto Rico has been hit by 2 hurricanes, a financial crisis that entailed many actors, including government mismanagement, bondholders, hedge funds, vultures, and then Hurricane Maria. I authored legislation that was included in S-2155. And that legislation that is known as the U.S. Territories Investor Protection Act closes a huge loophole that allow UBS and other financial firms operating in Puerto Rico and in any other U.S. territory to rip off millions from ordinary investors. So my question to you is, when can we expect the SEC to begin implementing this badly needed provision?
So thank you. This is the provision that removes the exemption from the 40 Act for
Correct.
funds organized.
Yes.
I thank you for that legislation. We are going to move forward with that. I think you characterized it correctly. It does close what could be characterized as a loophole, and it should be done.
Okay. I'm very excited to hear that. Mr. Clayton, I am also concerned that the position of advocate for small business capital formation has not been filled. Do you see any value to that position?
I am disappointed that we have not yet filled that position. We have employed a search firm to try and help us find the right person for that. But more importantly, to your question, why am I disappointed? I think that voice should be a permanent voice in the work we do at the
So
SEC.
when do you expect to fill that position?
I would like to fill it tomorrow. We have some candidates that we're vetting. This is a commission decision, so I can't speak for my fellow commissioners, but I would like to do it as quickly as possible.
Okay, so let me explain to you why I am so much concerned about the fact that that position has not been filled since almost, it was created in 2016. Earlier this year, language of my bill, 4792, the Small Business Access to Capital After a Natural Disaster Act, was enacted into law. The bill requires the SEC Advocate for Small Business Capital Formation to issue a report to Congress on ways small businesses can access private capital following a hurricane or other natural disaster. So this report cannot be issued until an advocate is hired. So I hear that you are committed and that you will not come here 6 months later, and I will ask the same question to hear that it has not been filled.
Yeah. I sure hope not.
And will you be interviewing candidates with experience on capital formation issues after a natural disaster?
We are interviewing candidates. In the context of interviewing candidates, the interviews that I have had, I have not asked that question, but I will now.
Well, but in terms of the specific language that was included into the bill requires for someone to be able to issue a report related to capital formation, access to capital formation after a natural disaster. Earlier this week, the SEC imposed Bank of America's subsidiary, Merrill Lynch, with a $42 million civil penalty for misleading customers about how it handled their orders. And while Merrill Lynch ended the scheme known as masking in May 2013, the SEC order indicates that Merrill Lynch did not inform customers about its past practices, but rather took steps to hide the misconduct. This follows an SEC announcement earlier this month that Merrill Lynch will pay more than $15 million to settle charges. Can you tell us how the SEC determined the level of fines and payments against Merrill Lynch in each of these two instances?
So I don't think it's appropriate for me to comment on the specific circumstances of a case. I can tell you that the way we operate is our division of enforcement and the people tasked with bringing these cases formulate a recommendation to the commission, and the fine and the other sanctions are part of that recommendation, and that's what we vote on.
Time of the gentlelady has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner, chair of our Oversight and Investigation Subcommittee.
Thank you, Chairman Henserling, and welcome, Chairman Clayton. Breaking news. The Supreme Court just ruled that the SEC did not follow proper procedures prior to your movement into this space and into this job when appointing administrative law judges. In fact, it says that these administrative law judges are appointed by the SEC and other federal agencies are inferior officers, and many of these inferior officers have adversely affected a number of my constituents in Missouri's 2nd Congressional District, and that that they are subject to the Appointments Clause of the Constitution. And I think this is going to have broad ramifications now for an array of federal agencies that employ in-house judges, including the SEC. I know this is breaking news, but I look forward to hearing how this will influence your practices at the SEC vis-a-vis the administrative law judges going forward. So just thought I would toss that out there. I want to start this morning by thanking you and your staff for their work on the proposed Best Interest Standard Rule. As many of my colleagues know, I have been an outspoken critic of the Department of Labor's misguided fiduciary rule, and I'm happy to see that the SEC is finally taking the lead, as Dodd-Frank frankly asked them to do some 8 years ago. In testimony before the committee last year, you identified key principles that you felt needed to guide the SEC's approach when seeking a new rule that is in fact a best interest standard for broker-dealers. And these areas were clarity, consistency, and coordination. Let me start by asking you this. Do you believe the SEC has achieved this goal in their proposed rule?
I do, and I want to say we took those concepts and then we added an additional lens and this was a truly collaborative effort around
with the Department of Labor, I hope too.
With the Department of Labor. I'm in contact with Secretary Acosta. Our staffs are in contact with each other. In fact, our inspection staff recently connected with the Department of Labor to show how we would inspect for compliance with this rule. We want to bring, a common approach to this space. The other thing that came out of this drafting process and interactions was let's align what investors expect from their professional with the law, because if we're aligning expectations, it's a lot easier to get clarity.
Agree. I have several more questions. You talked about having investor testing. Has that process started, and if not, are you still going to follow through with that part of the proposed rule?
So our Office of Investor Advocate is doing investor testing, but that's not the only investor testing we're doing. We have scheduled 6 town halls around the country to go out and interact with investors, explain the rule to them, ask them what they think about it. I've participated in the first 2. I plan to participate in 2 of the remaining 4.
Great.
That's actually really valuable.
Are you willing to
feedback.
make this feedback that you get from the investor testing public, sir?
Investor testing feedback?
Yeah. Well, are you willing to make this public, your findings through these investor testings? I know you're saying about a public town hall, so I assume that would be
That's all.
open.
That's all public. Comments are all public. I don't want to make a blanket statement, but I expect that the results of the investor testing will be publicly available in some
testimony
form.
before the Senate Appropriations Committee, you said, quote, "I'm not going to take forever," referring to completing the rule. I know the comment period ends the first week of August. Are you still on track, Chairman Clayton, to complete the comment period, or do you think you're going to need to extend it?
I think I'll see in August. But right now, I think good comment, good lengthy comment period of 90 days. And look, this issue's been around for at least 10 years.
Don't I know?
It's time for people have been heard.
Has response from the industry been positive? Because it's the industry that actually represents the low and middle income investors and retail savers that we are trying to protect. Has it been positive, the feedback?
I think, overall, I'm very pleased with the feedback.
So am I, and I've got preemption questions, Mr. Chairman, that I want to talk about, but I think I will submit those for the record, and I yield back the balance of my time, and I thank you for your tremendous work in this arena.
Time of the gentlelady has expired. Chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Lukemeyer and I and others have worked to try to have more information sent electronically, with paper only being sent when requested. And when you were here in October, I asked you about Rule 30E-3, and I want to thank you for moving forward with that rule, which will modernize the default delivery method for mutual fund disclosures from paper to electronic, while protecting a permanent right to paper for those who prefer it. You're going to save investors $2 billion. You're going to save 2 million trees. Good work. My question is, what more can the SEC do in terms of electronic delivery that can benefit investors and trees?
So that was 30E3 was a big step. I appreciate all the comments from this committee and others. I think we landed in a good spot, but it's just a start. As has been discussed in many of the questions today, modernizing our rules, including our communications methods, is front of mind in our Division of Investment Management, our Division of Corporation Finance, and throughout the SEC. On next Thursday, I expect we'll vote on XBRL and the inclusion of XBRL tagging, which, again, modernizing our delivery of data to the investment community.
Let me move on. The SEC has pretty much left it to the FASB, but accounting is what determines what happens to stock prices. And financial statements are based on a 100-year-old view as to what every company would disclose in terms of numerical information. But investors care. For example, if you're investing in retail stores, you want to know same-store sales. So I hope that the SEC would look toward either you or getting FASB to define the terms that are important to numerical information to investors in particular industries, and to make sure that those numbers are audited. Because right now, Target has one definition of same-store sales, Nordstrom has another, and both of them issue unaudited information. But I'll ask you to respond for that. For the record, I want to associate myself with the comments about cryptocurrencies. They are a security, as you pointed out to the Senate, and pick up on your comment about accredited investor rules. When these rules came out, the definition was $1 million in assets, 200,000 in income, and those were staggeringly high numbers in the 1980s. Now, in effect, those numbers represent 1/3 of the purchasing power. 10 times as many families fit into the category, which means 10 times as many families don't get the protection. One of my colleagues asked, well, why can't the average barber or teacher get all those great investments that seem to be reserved for? Why can't anybody charge into the minefield? Why do we limit that just to explosive ordnance disposal experts? Will you revisit the accredited investor definition and index up those numbers? Because either they were wrong when the SEC issued them or they're wrong now.
So there's a lot to, let me agree with you on the concept of an accredited investor definition, which is, no, we shouldn't just let people charge into the minefield, as you characterize it, without ascertaining to some extent whether they're capable of handling the private investment arena. Completely agree with that. We've chosen the accredited investor definition as that gatekeeping function to the private investment arena.
And this doesn't mean that they can't make the investment. It just means they need to get advice. And all those rich people who make these investments are getting advice and putting in effort.
Anyway, we can have a longer discussion about this because it's a very complicated issue.
I want to sneak in one more question. We had the meltdown in 2008 because the bond rating agencies gave AAA to Alt-A, they gave high ratings to bad bonds. We put into Dodd-Frank a provision, the Franken-Sherman Amendment, that would eliminate the system where the issuer selects the bond rating agency. We don't let the home team select the umpire, especially if the umpire makes $1 million a game. So I would hope the SEC found a loophole in that requirement, issued a report, and decided not to do it. That was your predecessor's mistake. I hope you'll take a look at this and use the power you have to end the issuer selects rater system.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, Chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and Chairman Clayton, good to see you again. Thanks for being with us. Some publicly traded firms, especially early-stage bio firms and some equity exchanges, have expressed concern about the absence of a disclosure requirement for those who bet against a company by taking a large short position in that company's stock. They point out that there is a regulatory gap between long and short sellers since there are extensive disclosure obligations for investors who bet on a company by buying its stock or investing long. They've argued in favor of a short position disclosure regime, noting that long positions over 5% of outstanding shares require public disclosure, while equally large short positions have no comparable requirement. On the other side of this argument, there are those who will point out the critical liquidity provided by short selling. They make the point that short positions are by definition not related to corporate ownership, and instead are a strategic trading tool. So they don't share the view that stealth short positions are as big of an issue. Again, they make the point that short positions provide critical liquidity to public markets and that short sellers are responsible for a substantial portion of equity trading volume, and that short sellers, because they provide that heterogeneity of views in equity markets about future share prices, provide efficiency to the markets. And the concern that they express with a disclosure regime would be that the reporting requirements would discourage institutional investors from taking short positions. Those reporting costs would then reduce overall short positions and therefore reduce market liquidity. So I'm just setting up the debate there. I would be interested, now of course there's a provision in Dodd-Frank that counsels the SEC in favor of a disclosure regime for short positions, large short positions. I'm wondering if you or the Commission has a view on this issue, and how would you approach that issue if asked to do so?
So I don't have a definitive view on a particular rule as we sit here today, or not a rule, but I think you framed it very well. If you don't mind, to try and give you my perspective, I'll frame it as I look at it, which is there are valid points in those arguments. The people who say that being able to go short and doing so as a fundamental view on the company adds liquidity, adds discipline, adds price transparency to the market. Great. I agree. There are people who say that there are people who use short selling, not because of a fundamentally different view of the price of the company, not to bring, not for liquidity, but to take advantage of trading opportunities that cause the company's quoted value to depart from what it otherwise might be. To the extent we can get at that type of behavior, if it exists, I don't know to the extent to which it exists, but if it exists, the extent to which it exists, without affecting liquidity and the discipline, that's how you should look at that problem, in my view.
Yeah, it is a balancing act for sure, and I appreciate your thoughts on that. In your last appearance before us, Mr. Chairman, you talked about the importance of reducing the reporting requirements for public companies to reduce some of the burdens that are maybe limiting IPOs, and you did respond with respect to a question I had about disclosures for mining companies, and I'm just wondering, in the response that you sent to us on March 23rd, indicated that you plan to finalize rules to modernize and clarify certain disclosure requirements for companies engaged in mining operations. Do you have any update on that?
We are working on a proposed rule. It's on our short-term agenda, and I'll just reiterate this. Our short-term agenda that we publish and are required to publish is what we're trying to finish in this fiscal year.
And finally, we recognize that getting the fiduciary rulemaking right is more important than rushing the process and getting it wrong. But as you know, many broker-dealers, in anticipation of the DOL rule, have invested a considerable amount of time and energy and resources in getting ready for that. Just curious about a timetable, because the uncertainty is creating some level of consternation.
Comment period ends in August. We'll collect the comments, go through the process. I'm not going to set a specific date, but I know that time, we should not take forever.
Thank you. Yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Welcome.
Apparently, I'm taking the
Clayton.
time back from the gentleman from
appreciate it.
Georgia.
Oh, you are?
Apparently, I'm not. in consultation with the minority, you get to keep your time. Gentleman from Georgia is recognized.
Wow, thank you, sir. I appreciate that. Welcome, Mr. Clayton. Always good to have you. You know, I've been at the front of the spear on this fiduciary rule since its very conception. You recall that when we put Dodd-Frank together, we required the SEC to come up with a rule that would raise the broker-dealer standard and would harmonize that standard with the obligations that investment advisors have to follow today. Now, here's the point. When we did that, we put that in Dodd-Frank, but we exclusively said that that was the SEC responsibility, not the Department of Labor. Now, the Department of Labor does have a piece in this, of course, with the retirement accounts. But you see where this is if we don't have the SEC at the leadership, being aggressive to be able to set these standards the way they are. So, as I said, I've been dealing with this. I was the only Democrat to cross over and vote for this bill with Ms. Wagner. We were able to increase that great bipartisanship when we got it to the floor with 2 more Democrats. And we're growing this bipartisanship, but there is great concern on both sides of the aisle, but certainly on mine, as to confusion within this. For example, in terms of establishing the best interests that you have going forward, you have said that to do this, we must meet several obligations. First, there's the disclosure obligation. Then we got the care obligation. Then we got the conflict of interest obligation. So my concern is a concern of both the investment community as well as the investor is that this concerns this complexity makes it difficult for the investment industry to discern what we need, which is a clear path to compliance. And you've done a remarkable job in explaining this. But I want to ask you that do you believe that the Securities and Exchange Commission is the best suited place to come up with a standard that indeed can be harmonized across all investment categories and all types of investment advisors?
I firmly believe that.
All right? Let me ask you this also, because here is another major concern, and this is where I understand the Labor Department's retirement situation. We're faced with an horrendous retirement boom right now because we have this baby boomer generation that really produced itself right after World War II that's coming. And so I wanted to know if you will commit to this committee today that your intention is to see this proposal through to the final rulemaking. Now, that question has been asked to you in a couple of different ways, but you haven't been clear. Are you going to be the man that's going to see this through to the end?
Well, no one person can do this, but this is.
Well, will you be the
this
captain of the ship?
Yes.
You said you will.
Yes.
All right. Thank you. Oh, he is?
Time of the gentleman,
All right. Thank you.
Thank you.
time of the gentleman
Glad you will be the captain of this.
has expired. Chair now recognizes the gentleman from Oklahoma, Mr. Lucas, former chairman of the House Agricultural Committee.
Thank you, Mr. Chairman, and I can't speak to the issue of who's captain of the ship, but in my time on this committee, I've always tried to be very pragmatic and very practical in my perspectives, my questions, and the focus. So if you don't mind, Chairman Clayton, let's visit for a moment about some issues that impact a very large and substantially important job creator in my district. And while everyone thinks about me as the ag guy, we have a major oil and gas industry in Oklahoma. And as many of my colleagues know, the United States has experienced a rather remarkable growth in energy independence, and that's occurred primarily due to the increase in shale production in places like the Bakken and in the Marcellus formations. But I'd like to focus on how the SEC treats proven but undeveloped reserves, because it concerns me a bit. Currently, domestic producers can report on their annual filings only those reserves they plan to recover within a 5-year window. And this has been the policy since 2008. And at that time, shale accounted for a much smaller percentage of oil and gas production than it does now. And I would suggest to you that this 5-year rule might not reflect the realities of the new American energy landscape. These shale formations are so vast and finite that a proper development plan will often exceed 5 years. So, Chairman Clayton, given this change in domestic energy production, have you and your staff given any thoughts to changing the 5-year rule for these reserves?
The short answer is yes. We have given thought, and let me make sure that if you indulge me, let me make sure we're on the same page. It's in particular yes, because I am concerned in this space that the way our rules require disclosure is inconsistent with the way investors value these companies. So they're looking for additional disclosures, and we should make sure that our rules line up with what investors think is the material information.
Exactly, because from my perspective, the 5-year rule may prevent a business from being able to disclose the full extent of its assets to investors.
And I'll actually just add to that when that's the case, you have information asymmetries, and that's not what we want.
And I'll leave with you on this particular question with one last thought, and that is 51% of all domestic crude oil and almost 64% of all domestic natural gas come from shale formations. And I think that's just amazing statement about the advances in technology and utilization and all of those things. Secondly, I noticed in your testimony that you expressed a commitment to working on the Commission's Title VII regulations surrounding security-based swaps. I very much appreciate this, given my desire to see derivatives markets work for all participants, and quite frankly, the long delay in getting these regulations out the door. I also very much appreciate your testimony mentioned active engagement with the CFTC. Can you elaborate on at all on some of that engagement with your colleagues at the other entity?
Yes, we have set up a bilateral process to get through the rules that we need to get through, with the hope of ensuring that they are either harmonized, or if we can't harmonize them because of our different mandates and the different types, that they are at least not inconsistent or creating problems for each other. But we are working closely with the CFTC, and I want to say I really appreciate the leadership of Chairman Giancarlo in that area.
I think he's a great leader, and you've touched on exactly the point that I was trying to make, whether it was Treasury reports last year calling for more harmonization or just the nature of the markets. I think it's critically important that everyone be able to utilize these tools in their businesses in the most cost-effective fashion possible. Therefore, Mr. Chairman, in that spirit of brevity and focus, I thank you for my time, and lo and behold, Mr. Chairman, I yield back.
Gentleman from Oklahoma yields back. Chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. And welcome, Commissioner Clayton. Now that I know that you are, in fact, the captain of the ship.
I knew that was going to get me in trouble. Thanks, Mr. Scott.
I want to follow up on some questions that I posed to one of your lieutenants, the director of the SEC's Division of Corporation and Finance in April. And I asked him about the SEC's intention to either adopt or reject recommendations from the agency's Investor Advisory Committee. The committee recommended better disclosure rules around dual-class stock structures. The advisory committee also recommended creating a pilot program to monitor shareholder disputes arising out of such structures. As you know, these structures are common among Silicon Valley's tech giants like Facebook. In fact, you may have seen where there was, I read in an article, an investors' revolt against Mark Zuckerberg at their annual shareholders meeting, because they can create a system where the average investors, including teachers and firefighters and the like, have less power to hold CEOs and board directors accountable. And we see when they can't, things can happen. So my question to you is, A, what's your personal opinion on the potential investor harm posed by dual-class stock structures? And B, what is the status of the Investor Advisory's recommendations at the SEC?
Okay, let me, if you don't mind, I'll take those in reverse order. The Investor Advisory Committee recommendation regarding making sure that the disclosure around governance and what dual-class structures mean to governance, and particular to your point, what it means to investors in terms of their ability to participate in governance, I 100% agree that that disclosure needs to be clear and accessible. And to the extent it's murky, it should not be. Your rights as a shareholder, whether they are one share, one vote, or whether there's a super vote stock that dilutes your voting ownership, you should be able to know that clearly from the disclosure. I believe that. So that. On my personal views on corporate governance, I am not a one-size-fits-all corporate governance person. My experience across our markets and across the globe is that trying to dictate a one-size-fits-all governance model for public companies does not make sense. I do recognize that there are models that are so extreme that they cause problems.
So these dual-class stock structures, you're saying in some places they may fit, in some places they may not. Is that what you're saying?
I think, yes, to the extent you take a dual-class structure to an extreme. Let me give you an example. Somebody has, complete voting ownership over a company, but has no economic stake in the game. As a person who looks at investments, that kind of outcome troubles me. Does it trouble me to say that a founding group of people who want to take their company public but don't want to be subject to the vagaries of short-termism should have some control over it? That absolutely resonates with me as well.
Thank you. That's clear. Let me also ask you, Commissioner Clayton, and I've asked you this before, about the SEC's intentions to go beyond merely monitoring its board diversity rule and to actually improving the board diversity rule. As you know, investors in the SEC's Advisory Committee on Small and Emerging Companies have found that the current board diversity rule to be unhelpful in determining the race, gender, and ethnicity of board directors. In April, your Director of Corporate Finance mentioned to me that the board diversity rule is back on the SEC's rulemaking agenda. Is this the case? And after monitoring compliance with the board diversity rule for some months, have you come to a conclusion on whether or not the rule should be enhanced so that investors could have more complete information on the composition of their boards?
Yes, it is the case. The dialogue that Director Hinman and his colleagues have had with companies around this, to the issues that you raised, has, I would say, raised some additional considerations about what companies think is appropriate and what the individual directors think is the appropriate type of disclosure. But I expect that we're going to move forward in some form. I never want to overpromise, some form with this rule. It's on our rulemaking agenda, and we're going to do something.
Thank you.
Time of the gentleman has expired. Chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Chairman Clayton, thanks for being with us today. I sure appreciate your hard work at the SEC over this last year. Really commend you as well for your regulation for the best interest for broker-dealers, and thanks for seeing that through. I think it'll be clearly important to protect investors and preserve their choices in the future. Chairman Clayton, tell me your impressions of FIMSAC, the Fixed Income Market Structure Advisory Committee, and after 6 months and its first meeting, and are you satisfied with where they're headed, and what's the focus of their agenda moving forward?
I am, look, it's early days, but if you ask me to give them a grade, I give them an A. This is a group of people who are giving up their time. It's a very diverse group of people in terms of perspectives, participation in the market. We have people who are in the public sector. I won't go all into it, but they're looking at how the fixed income market is evolving, and the fixed income market is evolving towards electronification. Products are changing, and they're trying to come up with recommendations that make sense to make the market better, including around trading and transparency, and we're going to benefit from their work.
At the end of the day, what will be the best outcome? What do you think can be achieved as a result of their input?
Adding liquidity to the market, people understanding where there may not be the liquidity that they think there is, and making sure that trading is efficient.
As it relates to corporate bond transactions, the block trades, do you intend to move forward with their FIMSAC's advisory board recommendations?
So that's a recommendation that has to go to FINRA in the first place, but I'm encouraging FINRA to take that recommendation very seriously.
Yes, sir. On another point, what legislative action do you think would be most helpful to support capital raising by new and small businesses?
Most helpful for small businesses?
Yes, new and small, sure.
So here's the conundrum for new and small businesses in terms of raising capital. And raising capital from a single source or several sources is not that costly, relatively. When you try to raise capital as a small business from multiple sources, the transactions costs are high. What we are looking at is ways to bring those transactions costs down without hurting investor protection. That's what we're trying to do.
Yes, sir. We've certainly see the impediments that have been there in the past, and any efforts that can be made there to allow greater capital investment.
And I think modernizing the definition of accredited investor is one of those steps, to be clear.
Thank you. Would you also speak to what the SEC is doing to ensure that small businesses remain the backbone of our economy? What do you foresee in terms of your role to ensure that small businesses have the central role in the backbone?
Small businesses are so important to our economy. We talked about capital raising for small businesses and access to capital, and the SEC has a role in that, just as our banking regulators and other regulators do, because they get capital in other ways. I'm hopeful that the way we're approaching the covered funds issue in Volcker will free up some capital for small businesses, particularly in areas of the country where there's not a large venture capital community. That's one of the things I'm hopeful for. Another thing for small businesses is to continue that path from being a small business. Now, some small businesses just stay small businesses, and they're an important part of our economy, but keeping that path from small businesses to become a bit larger, and having access to capital throughout the life cycle, that's an important part of our job.
You've seen it in the past decade, there's been a real limit and restriction in terms of the emergence of small business, and of course, that in itself, to me, has been the biggest concern that I've had on the ongoing growth of our economy, because without the infusion of the needed capital, the access to credit, and the ability for small business to emerge, our economy floundered. And that was my gravest concern, is what would happen in the future long term if this wasn't addressed.
So, can I add to that?
Yes, sir.
Just as a citizen, the connection between growing businesses and small businesses should not be lost out. You know, lots of businesses that move from small, medium-sized to large drive the creation of small businesses.
Yes, sir.
So we need to continue both of those things.
Thank you. My time's expired.
Time of the gentleman has expired. Chair now recognizes the gentleman from Colorado, Mr. Perlmutter.
Mr. Chairman, thanks for being here. We look forward to your visit to Colorado in a couple weeks. I've got 3 areas I want to talk to you about: marijuana, cybersecurity, and cryptocurrencies. So I'll start with marijuana. You know, we have the Controlled Substance Act, which is at odds with now 47 states and the District of Columbia that have some level of marijuana use, whether it's cannabis oil for seizures, medical marijuana, or fully legalized commercial sale. Canada, a couple days ago, just legalized marijuana. And we were talking earlier about IPOs and where have all the IPOs gone? Well, many of them have gone for a variety of reasons to the Canadian exchanges. So, and we know American marijuana businesses have gone public by holding IPOs on the Canadian Securities Exchange, the Toronto Exchange, and the TSX Exchange. So I'm curious, sir, whether you've seen any effort on our exchanges, either for marijuana businesses, direct marijuana businesses, or the ancillary businesses to marijuana, whether you've had any issues from an enforcement point of view or from a regulatory point of view in dealing with businesses here in the United States that publicly trade and are related to the marijuana business.
Nothing specific that comes to mind. I think what you're Are you saying, are we seeing impediments?
Yes. So have you had any cases where you, as a regulator or an enforcer of the law, have had to say, you can't take this company public, it violates the Controlled Substance Act? That would be one question. Another question is, if it's a company that the primary part of their business is to supply electric lighting or nursery kinds of things to marijuana grow operations. Is that something you would require as part of a disclosure?
Look, let's go back to the touchstone, which is materiality.
Yes.
If there's something material to investors in making the investment decision in connection with, for example, an IPO, and to use the industry you're talking about, is regulatory uncertainty or regulatory likelihood of additional regulatory developments something that should be disclosed to investors? And my position, I have to be careful about any specific type of thing, but yes, that's the type of disclosure you would expect to see in an industry subject to regulation, and in particular regulation that's in flux.
So has it come to your attention whether there's been an impediment, to use your word, or some sort of limitation to companies that may want to go public related to, a marijuana business or in supplying the marijuana business?
Well, I think, would an investor take into account the regulatory situation and whether they're going to invest or not? And would they pay less if there's regulatory uncertainty? That's possible.
So I'm asking a speculative question. I guess I'll just ask it more directly. Yeah. Have you personally run into any issues concerning the public offering of a marijuana business?
Not that I recall,
okay.
No.
All right. So let's just broaden it now. Forget about marijuana. Is there any kind of competition between the Canadian exchanges and the U.S. exchanges? Has that been where some of these IPOs have gone that the chairman was concerned about?
There is, to be clear, there is competition now around the world for listings. Where are you going to raise capital and where are you going to list your securities is a competitive business now. So I don't know, but I would expect there'd be competitive pressures in that industry.
So in your position, do you take a look at the limitations that, say, Canada may place on its public offerings versus what the U.S. does versus an Australian exchange?
I do look at those, and it's a competitive question, but there's also, I'm going to go in a direction that is slightly different. The investor protection regimes in other countries can be substantially different from they are here. And I think a lot of times our investors look at it, it's traded on XYZ exchange, and they think the investor protection is the same as if it's traded on one of our exchanges. And often it's not.
Okay. Thank you. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Holgren.
Thank you, Chairman. And Chairman Clayton, thank you so much for being here. Really do appreciate your work. I want to begin by briefly thanking you for proposing a rule for independence with respect to certain loans or debtor-creditor relationships. As participation in the capital markets has expanded and as technology has changed business models, the opportunity to update regulations to reflect these changes is essential. And so I want to thank you for your movement on the loan rule and your willingness to provide clarification. So thank you so much for that. We look forward to working with you on that as well. CFTC Chairman Giancarlo has testified before the House that we have, and I quote, he said, "We have some anecdotal information that shows that during the recent market volatility, the supplemental leverage ratio impacted larger market makers' ability to take on certain positions, thus exacerbating market volatility. The SLR is not specifically mandated in Title VII of Dodd-Frank, and it has had the opposite effect intended, pushing trades away from central clearing," end quote. Treasury Department's October 2017 report on capital markets also acknowledged the issue. I wonder, do you share similar concerns for the equities options market? And have you shared these concerns about options market liquidity with banking regulators, given that they have rulemaking authority for the risk and leverage-based capital rules?
So the issue that you bring up is an important one. Our cash markets, the stock market, as is familiar to American investors, is actually connected to the options market. People who provide liquidity in our cash market use the options markets as part of their business. And to the extent that liquidity drives up in the options market, it can cause a knock-on effect into the cash market. So this issue has been raised. I know that my fellow federal financial regulators are aware of it, and I think we should continue to look at it.
Great, thanks. I'm sure you heard, but the committee unanimously reported legislation just last week that would direct our banking regulators to address the issue. Again, it was bipartisan, worked through and got unanimous support. So again, thank you, and just would encourage the SEC to continue to work with bank regulators as well on that. I sent a letter last week to you raising concerns with FINRA Rule 4210. In short, I'm concerned that the margin requirements will push small to medium-sized dealers out of trading covered securities because of the competitive advantages to commercial banks and similar intermediaries that are not FINRA members. This is something we corresponded about last year as well, and I appreciate you providing a delay in the compliance date to spring of 2019. However, I'm continuing to hear serious concerns about the unlevel playing field that this would create. So I wanted to ask, in general, do you believe FINRA has the authority to regulate credit markets? This seems to be what is happening with the new margin requirements on certain mortgage transactions covered under 4210. And then also, will the Commission consider changes to the rule or working more closely with the Fed to address unlevel playing fields between FINRA members and non-FINRA members?
So the last part of your question is the part I can give a direct answer to, which is yes. I think we should, if there's an asymmetry in the costs of providing a service to clients, depending on whether you're within a bank or you're a standalone broker-dealer, we need to look at that. Your other question about, I do think FINRA has the authority to regulate broker-dealer conduct to the extent margin requirements go into that. The knock-on effects, et cetera, of that are a larger debate, but I'll leave it at that.
Okay, thank you. In general, as my time's running down, I'm interested in your views about the independence of the Financial Accounting Standards Board. It seems that this standard-setting body has drifted beyond the focus of the Commission and its staff in recent years. I wonder, do you believe the SEC is exercising sufficient oversight over the FASB to ensure that accounting standards meet the needs of investors in the financial market? And is FASB conducting a rigorous and transparent view of new or modified accounting standards to make sure that there would be no detrimental impact on financial markets? For example, is a quantitative cost-benefit analysis of the standards conducted?
So I believe that high-quality financial statements, it's a combination of accounting standards and then auditing standards that we have in this country have been fundamental to the great capital markets that we have. It's extremely important to me. It's extremely important to Wes Bricker, the head of our Office of Chief Accountant, our Chief Accountant at the SEC. This is a focus, and it's a focus not only inside the United States, but as U.S. investors have greater and greater exposure to non-U.S. companies, ensuring that those financial statements and those audits are on a level with ours. And we're participating, so we're participating both nationally and internationally in that debate.
Great. Thanks, Chairman Clayton. Yield back. Thanks, Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Chairman Clayton, for being here. When we were discussing prior to the start of your testimony, we discussed our shared enthusiasm for getting the consolidated audit trail implemented quickly and effectively. And I have a sort of searing memory of, I guess, roughly 8 years ago in this room, 4 days after the flash crash, we had testimony from the CFTC, which described how the evening after the flash crash, they had 30 people in a room looking over all the trade records, knowing exactly who did what when. And on the other hand, 4 days after the flash crash, the SEC was still in the process of collecting the data, which, to my mind, made something like the Consolidated Audit Trail an emergency. And here we are 8 years later. The Consolidated Audit Trail, as you note in your testimony, was supposed to be at least initially operating in November of 2017. Mm-hmm. And obviously, that deadline was blown. And so I was just wondering if you can describe where you think this is going and what you think Congress can expect as intermediate term milestones in getting this thing operating as I think we both believe it should.
So your question has embedded in it exactly what we've been trying to do since it became readily apparent that this was not going to be delivered on time or on spec, which is to require a work plan with milestones and goals. We now have a draft work plan from the SROs in front of us. It's long overdue, but we're now making progress. But we're making progress with.
Will you be able to share that work plan with Congress? Or at least a high-level summary of it?
I think that I think
milestones.
We can find a way. Look, I never like to answer a legal question without consulting. That's a bad habit I have, but or a good habit. But I can find a way to.
Milestones that Congress can track, so that we know whether we're just going to have another 8 years of no little action.
I have no problem with that kind of oversight.
Okay. Let's say another, one of the trickiest parts of this is the beneficial owner behind each trade in the Consolidated Audit Trail. From your testimony, you've had a lot of internal discussions about, exactly what that should consist of and how it gets implemented. And can you describe your thinking on that, particularly in view of the fact that a lot of the issues here are now international? That you have correlated markets across the world, and a lot of manipulation that you're worried about can happen internationally.
Yeah. So we're talking about two different functions of an audit trail. Going to the trading and the flash crash, having order types and the types of information that's contemplated by the Consolidated Audit Trail is exactly what you'd want from kind of a market integrity, surveillance, functioning point of view. When you turn to bad behavior and the ability to get at bad behavior, whether it's insider trading or manipulation, and what you bring up is, are there things going on in some market outside of our purview that when you connect them with things here, they reveal behavior that's bad when it would otherwise look fine. I think that's what you're...
That's one of the, often cited dangers of the international markets we have.
Yeah, and the way we conduct this today is we see something that we don't like, and then we inquire to get further information on who's behind those trades. The consolidated audit trail would make that process easier.
And what is the status of international discussions, getting comparable information? Well, are there comparable efforts, fully internationally here? Are there big holes in that international cooperation that you'd like to see patched? And how do you see the international aspects of this going?
So international cooperation, here's my sense, no study, but my sense, a little over a year into the job on this, international cooperation around what we'll call manipulative or insider trading has increased significantly. I will tell you that the legislation in Europe and here, I have no problem with it, around information protection, individual information protection, GDPR in the EU and what we do here. Getting through that in terms of cooperation around enforcement and surveillance is a task before us.
All right. Well, thank you. And my time's up, but it's important.
Gentleman yields back. The chair wishes to inform members there are 2 votes pending on the floor. I will yield to one more member, and then we will recess and reconvene at the conclusion of floor votes. The chair now recognizes the gentleman from California, Mr. Royce, chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. When we're looking at the proxy advisory industry, we have a stranglehold there. From my standpoint, we've got 2 firms holding 97% of the market. What do you think the main causes of this lack of competition are? And is it good for the voting process? Is there anything the SEC can do in order to help jumpstart some competition in this industry?
So why only, let me say this, why only 2 firms? Just my knowledge of economics, economies of scale. What the core function of those firms is aggregating data, crunching it, and producing data reports. You could see economies of scale coming to that.
I can see that it could lead to that outcome, but I do not know that it's in investors' interests not to have wider competition in the system, and I do wonder if there's things we could do that might make it more likely that it'd be a more competitive environment.
Yeah. And the role that proxy advisory firms play is something we are looking at.
Yes, that is what I would suggest. I'll ask you some other questions as well, but just to have that on the table for your purview is important.
They have a very important role in our regulatory ecosystem, and therefore we have to look at them.
Very good, very good. Here's another question, Chairman, that I'd raised to you. Earlier this year, this committee here passed legislation that would reverse a previous SEC rule requiring that certain money market funds float the NAV. Now, I certainly remember when the Federal Reserve Fund, or when the Reserve Fund in the industry broke the buck back in 2008. And I remember the massive backstop that the U.S. taxpayers provided to restart the process for the entire market. This is not the only thing that caused that meltdown, but it was a factor after the over-leverage of the GSEs and the over-leverage in the investment banks. The fact is that the value of the underlying assets of these products fluctuate. They go up and down. As I said in opposition to the bill at the time, if we learned anything from the financial crisis, it should be that price should reflect risk. So 6 months have passed, yet the bill still seems to have some life. Do you stand by your comments from last year? Let me just ask you, has anything changed in your estimation from the comments that you made on this subject?
No.
Okay. That is good news as far as I'm concerned. Chairman, let me ask you also, I chair the Foreign Affairs Committee here. I've witnessed firsthand that we have state-sponsored agents now, actors that are looking to do our companies and our country harm through cyber attacks. And the Commission clearly recognizes the problem with the updated interpretive guidance you have provided. We thank you for that. Undoubtedly, companies have a duty to disclose when a material cybersecurity event has occurred. But what more should they be telling shareholders about cybersecurity risks? I think that's something that has to go into the equation. And have you noticed an uptick in the number of companies disclosing these risks or disclosing the attacks?
I have, in my time focusing on this, I've noticed what I would consider to be, I'll just say the word improvement in disclosure about the risk profile of companies and the types of risks they face from cyber intrusions. I think we're starting to see what I would say is more measured and incident disclosure and more thoughtful, and I hope our guidance is helping companies with that. Now, I want to continue to work with companies and the investing public on how we should be approaching this issue.
My time's expired. Thank you, Chairman.
Time of the gentleman has expired. Pending conclusion of 2 votes on the floor, this committee stands in recess. To order. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Welcome, Chairman Clayton. Thank you for taking the pause and the recess. Before I begin, I want to take a moment to address some of the comments that Congressman Royce made prior to the recess. From my perspective, the problems caused by the SEC's rule changes respecting money markets remain an issue because the problems they caused are still apparent. This rule discriminated against municipal and corporate debt, and in doing so prompted the dislocation of $1 trillion. This led to an increased borrowing costs and caused an outcry in the municipal finance world. That's why my bipartisan legislation attracted broad support from over 70 co-sponsors, many of whom sit on this committee, and the endorsement of over 300 national, state, and local organizations and public leaders. Nothing in my bill would undo the helpful 2010 SEC reforms that improved liquidity, increased credit quality, and shortened maturities. What it would do is restore the level playing field between prime, tax-exempt, and government funds. This issue remains relevant and will continue to be relevant until the problem is fixed. And I understand the Senate is actually going to be taking another look at this week. But with that, I wanted to talk for a moment about your testimony. As you discussed in your testimony, there are still significant barriers that prevent companies from going public and staying public. The Jobs Act and successor legislation helped address some of these issues, but clearly there is more work that needs to be done. I have a bill that we will mark up later today that would extend certain disclosure exemptions for emerging growth companies or EGCs that would remain EGCs, but for the current 5-year limit. As you know, EGCs accounted for more than 90% of all IPOs over the last 2 years. Can you discuss some of the ways that we can help companies go public and stay public?
Yes, let me give you a general response to that question, which is I think the Jobs Act and the creation of the EGC concept for scaled disclosure and an on-ramp to being a public company was and remains a very good idea, and I would love to see that on-ramp be modernized to reflect the markets we have today. Specific areas are the thresholds. Are the thresholds where you have the benefit of being an EGC? Are they set in the appropriate place? Or should they reflect our markets of today and our experience with the Jobs Act? I think we should look at those thresholds. I'm happy to work with you and other members of this committee on setting them in the appropriate place. Other things that I just want to make sure I comment on, trading. Part of the attraction of going public is trading. And to the extent that we can facilitate better trading, more liquid trading in our small and medium-sized companies, I think we should be looking to do so.
Yeah, the Chairman Hensling touched a little bit on Sarbanes-Oxley with his opening round. This legislation was enacted 15 years ago in response to Enron and WorldCom and the scandals that they had. In your opinion, has Sarbanes-Oxley been effective?
You know, it's interesting. A sweeping piece of legislation to come to a single statement about any sweeping piece of legislation from a market's point of view is very difficult. There are aspects of Sarbanes-Oxley that I think investors got a significant bang for the buck. Independent audit committees, the focus on high-quality financial statements, that's a big bang for the buck. Some other things, you know, good, but not as significant as those.
What components of Sarbanes-Oxley represent the biggest cost and/or compliance challenges for companies?
I do think that from a let me give you an example. We're going to be looking at 404.
Great.
Okay. 404 applied to a large company and 404 applied to a smaller company. The relative burden on the smaller company has been higher. I've seen improvements in the area of application of 404, but I do think that we should look at that relative cost to the size of smaller companies and intend to do so.
What is the time frame for your review of 404? It's already started?
Yeah,
and
our staff is looking at 404 now, and we're going to be discussing it, at least plans for discussion at next Thursday's open meeting.
Yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chairman, very much. Chairman Clayton, I'm glad you could find me in this room. There are so many other people here now, but I'm sure this is only your second time before us, but I want to let you know, as Mr. Chairman knows, that he always saves the toughest questions for the end, but I'm sure you and I can get through this, so I appreciate very much you being here. I noticed that you folks over at the SEC have finalized Rule 30E-3, and I'm very grateful, sir, that you and I had a back and forth many times on this, and you're going to be looking out, I know, for the interests of small savers and investors throughout the state of Maine, throughout rural America, and I will be closely following this as the SEC implements this rule. But thank you very much for listening to my concerns. You folks are the primary regulator, Mr. Clayton, for non-bank financial institutions like pension advisors. And I worry a lot about our small businesses and our small savers and investors up in the state of Maine. And on FSOC, you are one of 10 votes. And you are the individual at the regulator that has the most influence, I would believe, on FSOC because your space is the asset manager space when it comes to FSOC. Now, what I'm concerned about, Mr. Clayton, is that when a non-bank financial institution like a pension advisor or a mutual fund company is designated FSOC, or if it would be designated FSOC, we all know the studies that regs costs will go up, rates of return will go down. I think Doug Holtz-Eaton concluded that something like a 25% reduction over time is the result of being designated as SIFI. And what drives me batty about this, sir, is that if you're in the asset manager community, the assets that you're running, the assets you have under management are not on your balance sheet. You're an agent for the customer. There is no systemic risk to the economy if something goes wrong, because it means that if my performance is better than yours, your clients will go from you to me and life goes on. So all I'm asking you, sir, is to take a hard look at Ross Delaney that passed this Congress on the floor, a big bipartisan vote, and obviously out of the committee. It establishes transparency and clear guidelines such that a fund company or an asset manager, if they're concerned about being designated as SIFI and going through these additional regulations and costs, and the investors get hurt because of those additional costs that are unnecessary, that there is a off-ramp. There is a set of guidelines that says, if I do this, I can get underneath this regulatory regime that is unnecessary. So can I get a commitment from you today, Mr. Clayton, that you're going to be looking really hard and making sure that there is transparency and clear guidelines when it comes to non-bank financial institutions being designated or not as SIFIs?
So I'm not going to commit my other members of FSOC to a particular process.
No, but you have the most influence when it comes to this space on FSOC, I would argue.
But what I can say is I understand the comments you're making. I understand the concerns, and I am certain that those concerns and comments will be discussed by that group.
And I would encourage you to discuss them in the most energetic and passionate way on behalf of those that should not be designated SIFIs. Thank you, sir. Moving on to another issue. The last time the SEC updated its rules on promotion and advertisement when it comes to asset managers was, I think it was 1961. In 1961, Roger and I were just kids, and I don't think, if I'm not mistaken, the internet or social media hadn't even been invented yet. So will you take a look, sir, and commit today to the people listening that you'll commit to taking another look at social media and the use of the internet for asset managers to do what other companies do in this world, which is promote what they're selling?
So we are, and when we rolled out 30E-3, we also rolled out investor experience questions, and we are looking at enhancing our communications with investors, and in particular, to make sure that investor communications reflect the communication technologies of today.
I hear that as a lean yes. Thank you very much, Mr. Clayton. Lastly, in my remaining time here, Rule 14A-8 dealing with shareholder proposals. Last time you were here, sir, we discussed this a little bit. And look, every shareholder has the opportunity to weigh in with management when it comes to how the company is being run, products offered, and so forth and so on. But a $2,000 threshold, owning that for 1 year, gives you an opportunity to express your views. I understand that, but it also drives up the costs, drives up what Mr. Hensling said a short time ago about the hassles about going public. And I worry about every other small investor in Maine and America that wants the opportunity to own part of America. Are you going to be looking at 14A-8 also, sir?
I want to look at the whole proxy process, including 14A-8.
Thank you for that commitment, Mr. Chairman. Appreciate it.
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman. And the last time you were here before this committee, you and I had a productive discussion about retail and affinity fraud. You mentioned that it was important to think creatively about ways that we can structure our behavior, so that is more important, more difficult to commit a fraud. It becomes harder. I'm encouraged to hear that you've turned your attention to Main Street businesses that play such a critical role in our economy and in our local communities. So my question, Mr. Chairman, since your last visit, can you provide any updates on retail fraud or any related tasks that your teams may be undertaking to target and prevent future fraud?
We did form a retail fraud strategy task force. I shouldn't say we, our Division of Enforcement did. I appreciate that they've done that to focus on this. So a group of people dedicated to rooting out retail fraud. More importantly, there are a number of Ponzi schemes where we've identified them, brought asset freezes, brought them to a halt. I'd like to think as quickly as we could, because the longer they go on, the more money that goes away, and the less money we can get back for investors. That's been a focus of ours. The ICO space, let me preface this by saying, like I do, the distributed ledger technology and blockchain technology, whatever you want to call it, has promise. But the ICO space had a great deal of retail fraud. And I'm very pleased that our enforcement division has pivoted to addressing that issue.
Thank you. Now, you yourself have rightly recognized that a vibrant IPO market allows Main Street investors to be able to participate in crucial growth, the process of growing. So can you touch on the role of the Small Business Capital Formation Advocate Office and what steps it will take to allow for growth in Main Street investor participation?
So thank you for that question. Obviously, that office is new and will be, as any new office, it will find its way. It has some directions from Congress. What I really want, and when I'm talking to candidates for that, I want somebody who, when we're making rules or a policy, says, hey, this is how this is going to affect a small business, so think about it when you do this. You know, in particular, you know what? This is too costly to apply to a small business, or this won't help a small business. Here's how we could adjust the rule without adversely affecting investor protection or transparency. It will be good to have somebody in the building where that's their job.
Lastly, you have a unique vantage point in your current role, one that requires you to work across several industries and countless stakeholders. So if possible, can you give this committee your personal assessment on the health of the economy and on what we should be concerned about or excited about?
So health of the economy, that's out of my lane.
But it's good, I'll tell you that.
It's good. Okay. Our job is to make sure that the markets function as well as they can to support our economy. And there's always room for improvement in that. We come to work, not just me, we come to work every day looking to improve the functioning of our markets so the economy can be as good as it possibly can be.
Thank you. I have some time left. I yield back to the chairman.
Gentleman yields back. Chair now recognizes the gentleman from North Carolina, Mr. Budd.
Thank you, Mr. Chairman, and also Chairman Clayton. We're fortunate to have you at the helm. I guess that makes you captain of the ship, as we heard earlier. So we appreciate you being here and being our captain. So I wanted to get your views on some recent legislation that the committee approved that would raise thresholds for shareholder resubmissions. It seems pretty straightforward in the simple proposal for the FCC to enact, and I think Mr. Duffy's legislation offers a much more reasonable threshold that allows shareholders to have a voice while not burdening public companies with proposals supported by a very, very small group of shareholders. So while I strongly support this legislation moving forward, what can the SEC do to make these changes in the meantime?
We can look at the proxy process, and I intend to look at that as part of an overall assessment of the proxy process. I think, if you don't mind, I'd take a minute.
Please do.
The ordinary investor, the retail investor, the Main Street investor, the people we think about, I think they should understand that corporate governance in America has changed substantially in the last decade as a result of various changes, and that the ability of shareholders to directly influence the actions of management has increased. Now, that has benefits, but it's been a change. And we should be looking at that change and how it has changed the way corporations behave. And I think communicating with American investors on what that change means.
So you mentioned looking at the proxy process. What sort of timeline would you anticipate for the SEC looking at that process?
We had an open comment period in the past. I'm contemplating opening that again.
Okay.
To get updates on this issue and other issues that are around the proxy process.
Good, thank you.
Including the plumbing. You know, do we have the right plumbing in light of, with the theme of modernization? Do we have the right plumbing for the proxy process?
Very good questions. Look forward to hearing the results on that. So further, I want to switch over to virtual currencies for a moment and sort of tag teams a little bit with Mr. Williams, my colleague, about investor fraud. Can you just tell me what criteria the SEC is using to determine which token projects should be targeted for enforcement actions? And then further, is that criteria focused on promises made by the developers of those token projects, or is it focused on the expectations of purchasers, irrespective of any promises or marketing materials made by the developers of these projects, or some combination?
So let me say what I'm not going to do. I'm not going to discuss allocations of enforcement resources to one particular type of bad activity versus another. If you're behaving badly in this market, we don't want you to do that. In terms of what I would like people in this market to understand, is that there is a way to raise capital that's compliant with the law. And I want people in this space to recognize that and do that. And if after a year of this kind of dialogue that we've been having, people aren't moving to that, I've got a problem with that.
So noted. Thank you for your time, Mr. Chairman.
Thank you.
And Chairman, I yield back.
Gentleman yields back. Chair now recognizes the gentlelady from New York, Ms. Tenney.
Thank you, Mr. Chairman, and thank you, sir. I'm always last in line, so hopefully I'm not going to be too repetitive. I just have a couple of quick ideas. Obviously, in my region, there's been this vilification of anyone who operates a so-called corporation or entity that seeks to look like a corporation, whether it's an S corp, a C corp, an LLC. But in that realm, we have had a number of issues trying to get into the initial public offering space, and we appreciate your efforts in trying to move us more to an entrepreneurial ability and providing more capital formation and chances. What do you think are the key steps that you're looking to take in addition to what I missed some of your testimony, what you may have said, to getting us to get the smaller businesses and to assist the formation of capital and growth in an area, for example, where I'm from in upstate New York, where we don't have the city next to us. We have small banks, we have fintech and others. How is SEC going to impact us, your new rules, on helping us get there with some of our new businesses?
So let's, I talked before about providing a path to being a larger company. Let's just stay in the smaller company space. I would like to see us modernize the accredited investor definition.
Okay.
to make it easier for more people to participate in funding small businesses. I'd like us to use technology to eliminate some of the unnecessary frictions that go into raising capital on a smaller scale. Those are things that we're looking at. In terms of availability of funds in different parts of the country, outside of places that have a great deal of venture funding, I'm hopeful that some of the things that we're doing in Volcker or proposed to be doing in Volcker will free some more local capital. Those are.
Have you seen any of that happening yet in any of the initiatives you've taken? Because I know in my prior life, before I got involved in this job in Congress, I had a lot of trouble getting some of my entrepreneurs to find investors, and they feared the IPO space a little bit because of just the rules, the regulations, and the SEC. How are you can you identify a couple things you're doing to simplify that, and also ways of making if you've seen progress, if you've seen more IPOs coming up forward in the small business space, is that something you have data on or something you could provide us with? Because I'd love to know if what you're doing is actually helping. Are we actually moving people more into the space than with some kind of data of some kind?
Well, let me say this. Yeah. I think a year is too early to tell.
Okay.
Okay. One of the issues about measuring success in this space is sometimes it takes a fair amount of time. The IPO process itself, from the time a company thinks about a public offering until they actually achieve a float, it starts long before they contact us, and it takes a while. So that's a long-winded way of saying, I don't want to take credit for any uptick in IPOs. I don't want to say we're unsuccessful. I think we're doing the right things.
Yeah, I mean, I believe that. I've been in the situation where I've taken my clients to other areas to try to find ways of getting them resources and getting them funding. I think that now it looks like we're in a better space than we were. And I just was wondering if there's any demonstrable change.
I think we're in a better space than we were. It feels like we're a better space. The activity that I'm seeing, I like. Do I want to say, absolutely, here's some demonstrable evidence?
So next year you'll have some more data for us when we get to that. I just want to jump to the whole cryptocurrency, Bitcoin, everything. That's the excitement of the day, and what the SEC is doing about that. What are we going to be looking at as this becomes very popular and more investors and people are getting involved in the cryptocurrency? What's the SEC's reaction? Maybe if you could point out one or two things in the last 30 seconds about what you're doing in that, because I'm running out of time.
Okay. So in the pure cryptocurrency space, the examples that people cite are Bitcoin or Ethereum. That's not in our direct jurisdiction, although I have, there are issues with those crypto assets, including in the trading and what people use. I want to be clear, to the extent that somebody is bringing those assets to a regulated entity of ours, that regulated entity needs to go through the same KYC and AML procedures. In the sort of token space, we're raising, I think we've raised the consciousness for people to understand that these are securities and they need to follow our rules. I do think this technology has a lot of promise and it can eliminate costs. I would focus on that. I'm sorry.
Thank you. Thank you. I'm sorry, my time's expired. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Yeah, thank you, sir, for joining us today, Mr. Chairman. Appreciate it. Last year, Congress passed a multi-trillion-dollar tax cut for, as you're well aware, and I think the theory behind it is reported in the press and by some of my colleagues was that it would spur investment and thereby increase hiring for working people. But some of the data has really come in, and according to the Bureau of Labor Statistics, wages for most workers by 80% are actually down since the tax cut passed. So what are the companies doing with the windfall? I guess one of the things that at least the popular press indicates is that there's been a lot of stock buybacks. How do you
react to that assessment? basically, I don't have the data, but if what you're asking me to be direct is companies that have repatriated capital and are holding cash, what are they using that cash for?
Yeah.
And to the extent they're using it for stock buybacks, what do I think about that? Is that?
I suppose that's pretty
Stock buybacks are an efficient means to return capital to shareholders. They're more tax efficient than a dividend, for example. So that's probably going into the judgment.
So that's kind of a policy that you support?
Yeah, like I said.
You think it's a legitimate way to operate in light of?
Here's what I think. The company decides to do that, they should be telling the shareholders what they're doing with their money and do it in the most responsible way.
Okay. In the first quarter of 2018 alone, corporations brought back a record $178 billion in stock. And according to a survey of major corporations, CEOs say that the stock buybacks are their number one use of capital. So instead of spending the money on wages or investment in research and development, they're going big into these stock buybacks, as you indicated. So I guess my question for you is this. Last week, your colleague, Commissioner Jackson, called on the SEC to revisit its stock buyback rule, which hasn't been revised in 15 years. Do you agree, or how do you react to the suggestion that Commissioner Jackson made? Do you think it's open, it's a good time to open up for public comment the rule on stock buybacks?
So I after I asked Commissioner Jackson what he meant, because I think our rule around stock buybacks doesn't go to the decision of whether you should do a buyback or not. In fact, it doesn't really go to we have rules that go to the disclosure of stock buybacks. I don't think he was talking about that. I do think disclosure of stock buybacks is important. People who are shareholders should know whether you're buying back stock or using it for the other things. But our rule goes to how you actually affect it in the market.
Okay, given the time's wasting, I hope you forgive me for cutting in.
Yeah, no problem.
Do you agree with Commissioner Jackson that the huge surge in stock buyback activity can lead to problems, particularly since the research shows that a substantial number of CEOs use buybacks to cash out their own shares?
Well, what's interesting is executives sell stock on a regular basis, and they have to tell us. They have to file forms when they're selling stock. I'm not sure about a connection between stock buybacks and executives selling, but what I want to make clear is that kind of activity, it's got to be disclosed to the marketplace so that we can look at it to see if there's any connection. And I would... Okay, go ahead.
So let me just tell you this. There's a report my office just recently drafted. I'd like to share this with you and submit one for the record without objection.
Without objection.
And just so you know, I mean, in 1968, the average CEO made about 20 to 1, about 80, about 34 to 1. Now it's 339 to 1. But that hides a few facts there, Mr. Chairman. Mattel has nearly 5,000 to 1. McDonald's 3,100 to 1. The Gap 2,900 to 1. Walmart 1,100 to 1. Are you concerned by those numbers? And does that level of executive compensation create instability in the market? And isn't at least part of our income inequality problem because of the dramatic shift in how people are compensated?
Gentleman's time's expired. Quickly, you can respond.
Quickly respond. I want to make sure that shareholders understand how people are being compensated and the criteria that go into making those decisions. How is the comp committee making those decisions? That's an important part of shareholder communications.
Thank you, sir.
Thank you.
Gentleman yields back. Chairman recognizes himself for 5 minutes. Chairman Clayton, glad to have you before the committee today. Thanks for your incredible stamina for being here today. We're glad to have your answers to all of our questions. I wanted to start and talk about a FINRA rule, Rule 4210, which I've got concerns about in terms of the fairness issue between bank-owned broker-dealers and non-bank-owned broker-dealers. It relates to the agency's security market and posting margin for that. I won't debate with you today whether or not the SEC has the authority to impose margin requirements, thinking that perhaps the Federal Reserve Act governs that. But would you agree that we don't want to have public policy that, on the face of it, discriminates by organizational entity? In other words, in this example, bank-owned versus non-bank-owned broker-dealers.
I agree.
So Mr. Quarles, when he was here representing the Federal Reserve, he agrees as well. So would you be willing to work with the Federal Reserve to create a common sense solution here that's fair to the brokerage community at large?
Yes.
Thank you, I appreciate that. Also, I've introduced a bill, H.R. 6021, which is of interest also to the brokerage community. This goes back to my days in the industry as an independent broker-dealer and a bank broker-dealer as well, as it relates to small, privately held dealers that don't hold customer funds and are purely introducing brokers under the rules. And this goes all the way back to Sarbanes-Oxley, where all brokerage firms were required to have a public accounting oversight board qualified auditor, no matter their size or complexity. This bill, and Senator Cotton's introduced a companion in the Senate, would permanently waive that for small, private, non-custodial broker-dealers, something we got waivers for along the way between 2002 and recent years. Is that something you think the Commission could support, knowing that they still fully comply with SEC rules, FINRA rules on audited financial statements in accordance with GAAP? Because the other thing I've learned in this process in the ensuing years is the number of qualified firms has dropped, something that I personally had not known until I started studying this issue.
So the short answer is yes. The longer answer is I liked the criteria that you cited in terms of who we're talking about, and we've actually raised this issue with the PCAOB to get their views. I don't want to get ahead of them, but I expect their views would be that, this is not an area. Well, let me put it this way. This is an area where we should question whether this is a necessary step,
Right.
particularly in light of the criteria you cited.
Well, thanks for that constructive nature. There's this hearing, this committee hears testimony all the time about tailoring regulations for community banks. I mean, it's weekly for 8 years at least. We don't always pay attention to tailoring our rules through FINRA and through the Commission for our very small entrepreneurial broker-dealers, and yet the burden shift is very similar. So I appreciate your...
Particularly those, like you said, that don't hold customer assets.
Yeah, and let's be clear again, just for our viewers, these are privately held companies that are introducing brokers, which means they clear all their securities through a clearing agent, and so they're not holding customer funds, because we're all sensitive to making sure that you oversee these entities in a safe and sound manner.
And thank you for doing that, because I just want to make clear that that's a distinction that's very important to me.
It is, and it's important to these members, but you would be, I don't think in any way, what I've seen is just audit fees have gone from maybe $5,000 to $8,000 a year for a typical GAAP small introducing broker that is overseen by FINRA at your direction, and some of those have tripled as the number of compliant accounting firms drops and the complexity of doing that exam goes up. I'm not sure the Commission is getting, concomitant big safety and soundness gains. So thank you for that. Last topic I want to just introduce is one of my favorites, and that is how the federal government's trying to interpret the Volcker Rule. And the SEC's recently participated in the release of a Volcker 2.0. A lot of us up here found it very complex. I'm not sure you made a big improvement there, not you personally, but that the collective agencies did. Are you going to be very diligent at looking at the comments for the Volcker Rule reproposal?
Certainly around the commentary. Certainly, I think this is an area where the comments are going to be illuminating.
Thank you. I appreciate that. The chairman's time has more than expired. I'm going to now recognize the gentleman from West Virginia for 5 minutes, Mr. Mooney.
Thank you, Mr. Chairman. First, Secretary Powell, thank you for coming here and taking all these questions and the good work you're doing there. I wanted to make a comment and then a question. I want to add my appreciation for your leadership in proposing an expansive loan rule aperture. As private equity's role in the capital markets has expanded and as technology has changed business models, the opportunity to update regulations to reflect these changes is long overdue. Current regulatory impediments, they deter capital formation, they limit competition, and decrease efficiencies. So just thank you for addressing this. That's very important. And then, I'm from a rural area, West Virginia, and I think there's a misconception out there that investing in business startups and a lot of things we need in this country are for people in big cities or people with large bank accounts, but they're for people in rural areas too. And I'd like for you to tell me the importance of capital formation to investments and workers in rural areas.
Well, all I can say is I agree with you. The availability of capital, whether it's through investment or through credit, is essential to starting a business. That's just all there is to it. Yep. So I agree.
I was at a fair about a year ago, and a young lady there had found a way in West Virginia to get syrup from trees. Mm-hmm. And she wanted to started a small business to make this syrup and sell it. And I say she was at a craft fair, and she was showing her display there. And she had the hardest time finding anyone to give her an initial startup loan to invest in this product. Went to banks, went to administrations, just couldn't find anybody to do it. The restrictions, these restrictions, I think they're well intended by the other side, but they're hurting the people that need these investment startup dollars. This is a family that had a dream in my district, and they could make it come true. It was a great product. They tasted it, and they just couldn't find anyone to invest. So I just want to encourage you to continue this deregulation, get these impediments out of the way for Americans in rural areas, as well as, cities, so they can have their dream of owning their own business come true. And with that, Mr. Chairman, I'll go ahead and yield back the balance of my time.
Gentleman from West Virginia yields back the balance of his time. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Mr. Chairman. Looks like maybe I'm batting cleanup here today, so I'll try to keep this as brief as possible. Thank you, Mr. Chairman, for being here and taking this amount of time. It's very encouraging. I also want to thank you for your work in the best interest standard for brokers. I can tell you every time I would be at home after the Department of Labor's Fiduciary Rule, I was inundated with brokers and those advisors with the confusion and the difficulty that this provided them, and it was a significant impact, and I thank you for the work that you've done there. Now, you stated that the slow pace of initial public offerings is a significant problem, and with what I would call mind-boggling growth of our economy. I mean, the GDP is up 3%, knocking at the door of 4% possibly. Wages are increasing. Consumer confidence is growing. I mean, every statistic is way beyond anything that anyone ever anticipated we would be at 2 years ago. And I think, we're all celebrating that, or at least most of us are. Because of all that growth, it may not be clear why the slow pace of IPOs is a problem. Can you explain why not seeing new initial public offerings in the light of a robust economy is a real concern?
So we just talked about the capital being essential to growth. The availability of capital is strong. Right? We have private capital markets that are as strong as they've ever been. The availability of private capital to finance growth. That said, it still does trouble me that our public capital markets are less attractive. I don't want to do anything to impede capital. I don't want to do anything to the private capital market in order to make the public capital market relatively better. This is a good thing, let's not do anything to it. But broad participation in capital formation and investment in America is a good thing. And I want to make sure we continue to have broad participation. And the public capital markets are the most efficient way for ordinary Americans to get access to investment opportunities.
And I do agree with you, and I just think there's a confusion with a lot of folks in that. But how how does this interact with the anticipated increase of mergers and acquisitions we're expecting?
So, look, the number of companies in our public capital markets can be reduced for a number of reasons. People go private, they merge, things like that. To the extent that pipeline isn't being filled, you have fewer choices. Now, when two public companies merge, you have a larger.
Right.
You don't lose capital in the public markets, but you do lose the numbers.
Okay. Move on to another topic, cryptocurrencies, something I've been following for a while with an IT background. I agree that we've seen cryptocurrencies being used for nefarious purposes, money laundering, terrorism financing, human trafficking, drugs. However, I believe the underlying technology of blockchain is something that we should pay close attention to, and I think we need to divest the cryptocurrency from the underlying technology, and I've been advocating for us to look at the blockchain technology as a potential technology to resolve some of our cybersecurity concerns and issues. I just want to get your thoughts on that.
I agree with you.
Okay, thank you. Mr. Chairman, I yield back.
Gentleman from Georgia yields back, and now it's my pleasure to recognize my good friend from Connecticut, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Clayton, it's great to see you. Thank you for being here. I think I may be the last here, although you never know who's going to appear. But great to see you here, and I really want to just start by commending you. I read the testimony here, and this emphasis on Main Street investors and all that gives them confidence, and I think that's a great approach. I really appreciate your intense focus on ICOs. To me, the frenzy in that space feels a lot like what I remember in kind of 99 and 2000 around the internet space, and I think there's a real opportunity for people to get hurt, and so I really appreciate your focus and aggressive attention to that. I want to bring up two topics, neither of which will surprise you, both of which I think are consistent with Main Street confidence. One indirectly, which is something I know we've talked about before, but my ongoing obsession with what I think is questionable behavior and the charging of fees in initial public offerings and the absolute perfect consistency of the 7% gross spread. And the reason I care about that, maybe it's not so much Main Street investors, but you tout the Jobs Act, and we're working on sort of Jobs 2.0, and we're talking about saving young companies $1 million, $2 million, $3 million max in their early stages, and an IPO of $200 million at a 7% gross spread, that's $14 million. So we're talking about very real money that comes at a very sensitive time for young companies. Since we last talked about this, I've sent you a letter noting that one of your fellow commissioners has taken an interest in this, and Mr. Eggers, who was before us, agreed with me that it didn't feel like competitive behavior. So anyway, I sent you a letter and very much hope, I'm not prejudging this, but I'm saying there's enough there that we and FINRA and you need to take a look and make sure that we've got good competitive market capitalism operating in IPO pricing. There's no question there, but
you and I share a passion for competitive markets.
Okay. Well, the letter makes a specific ask that you and FINRA study it. I'm not going to hold you to that right now because I suspect you're probably just gotten the letter and looking at it, but I do think it's important to young companies. More to, again, consistent with Main Street investors, and this is really about Main Street confidence. I continue to be very concerned about what I regard as sort of the legal ambiguity and mess around insider trading. And I continue to be troubled by the fact that it looks like we have inconsistent, unpredictable, fuzzy law around insider trading, driven largely by decisions, some of which go with each other and some of which don't in the Second Circuit. And so I would like to, there actually is a question attached to this speech, which is I would like to just hear you for a minute or two on whether you think the time is right for Congress to finally, in statute, define the crime of insider trading.
So, you and I've talked about this. I've talked about it with people who are very experienced, including judges, people who hear the cases. There are arguments both ways on this. Bringing more certainty to the space eliminates some of the behavior that troubles you, that you feel is not caught. I think if I don't want to assume, but you're troubled by the fact that there's probably some behavior that you think should be sanctioned and isn't?
No, I'm not.
Or
yes, but I'm actually, in the spirit of Main Street competence, look, I'm not a lawyer and I'm not an expert on a lot of things, but I am an expert on public sentiment because that's what I do. And there is just a general sense out there with all of the reversals of convictions and with all the activity in the Second Circuit in particular that we really have no idea what insider trading is, and somebody gets convicted and the conviction gets overturned. That in the aggregate is a huge source of uncertainty and therefore risk in the minds of individual investors who say, why should I play if I'm at a disadvantage because I'm doing this honestly?
Understand that. I'm not sure that a statutory approach would bring any more clarity. That's my issue in a nutshell. I'm very happy to discuss it, look at it, but when you look at jurisdictions that do have a statutory approach, I'm not sure that there's any greater clarity regarding behavior. I can tell you, and look, you should know how I feel about this. I may be biased. When people bring me, when I was in the private sector, fact patterns and would say, hey, what do you think about this activity? It wasn't very hard for me to say, I don't like that. Yeah.
Okay. To be continued. Thank you very much, Mr. Chairman. And Chairman, I yield back balance of my time.
Gentleman from Connecticut yields back. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Chairman, thank you so much for being here, and thanks for the work you and your team are doing at the SEC to make sure our capital markets stay the world's best. I especially appreciate the work you're doing on ICOs, and we'll spend a lot of time on that, hopefully, or what little time I have. With one sidebar. Earlier this year, I introduced the Due Process Restoration Act, earlier this Congress, and it relates to the SEC's use of administrative law judges. As you now know, the Supreme Court has ruled that this practice is unlawful, unconstitutional, and should not proceed. Could you give us any guidance or reaction to that decision?
No, because I haven't read it.
Fair point, and look forward to working with the SEC on how to move forward and how might our existing law or bill really fit with the path forward. Toward that end, our office is building the what we hope to be the first ICO body of law in terms of clarity around the regulatory framework for ICOs, because I think a light touch regulatory framework can do for our capital markets with ICOs what it's done on so many other things: provide certainty, provide clarity, and provide security, not just national security, but for protections against fraud. I've been concerned that the disparate set of court opinions might not be as coherent as we would like, or frankly, the SEC would like, consumers would like, and in particular, investors would like. So if the U.S. is going to truly be a world leader in this critical distributed ledger technology, I think we need to get this regulatory certainty. To use an example of folks that have tried to do this, Ripple's just one of many digital assets that come to mind, and I'm aware there are numerous court cases regarding this company. Do you think it's prudent for Congress or the SEC to lead the way in clarifying what is a security or commodity instead of waiting for the courts?
So I think as regulators of the securities market, it's important for us to bring clarity to those markets. I do. But I think we are doing that. We have turned to this space. We've issued guidance. The space is developing. But all of that guidance and our enforcement actions are rooted in a very well-tested approach to the raising of capital in the United States. And I can't be more clear about this. I am not going to advocate for any fundamental changes in the way we raise capital to accommodate the technology. Now, the technology can make what we do more efficient, but I'm not going to change the rules because we have a new technology.
Yeah, fair point. The Howey test has been there, and I appreciate, frankly, Director Hinman last week clarifying that Ether is not viewed as a security. There had been some concern after some of your remarks that everything looks like it fits with the Howey test, and, you know.
When you're raising capital for a project?
Right, and as I think you and I agree, certainly many companies have essentially engaged in regulatory arbitrage and used white papers to raise more capital than they could through the existing framework. However, some companies, for securities, and that body of law, I think you guys have taken an effective approach.
And we want to help people. Look, I'm not saying do it, and then we want to help people.
And you set up an office to be able to do that, and equipped it with resources. So I appreciate that. One example, though, of people that have tried to follow, like the Reg A+, that has a 90-day period where they're supposed to receive feedback. But there are companies that have gone well past 90 days at this point, and they're waiting for a decision. So is that decision delayed because Reg A+ decisions are normally delayed, or is that because we're going through a different set of scrutiny for ICO-type companies?
I'm not aware of any specific facts, but I can tell you that the Reg A process, if somebody submits a deficient filing, it's going to take longer than the usual period of time because you have to send it back to them and have them resubmit, like if it doesn't have financial statements.
Correct. Yeah. So it could be specific things, but I just want to highlight you guys have made a way forward for people to comply with existing security laws, and you have done good enforcement actions. I look forward to seeing how you move forward and look forward to continuing to cooperate to launch this legislative certainty. My time has expired, and I yield, Chairman.
Thank you.
Gentleman's time has expired. Now, the gentleman from Nevada is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Clayton, for being here this afternoon. As you are aware, Las Vegas suffered the worst mass shooting in modern history last October, October 1st. Las Vegas is my hometown. I represent part of Las Vegas. 58 people lost their lives, and over 500 people were injured. My community, as you can imagine, is still trying to heal from this tragedy. Now, given Congress's refusal to take any efforts to prevent gun violence, we have seen many corporations step up. From Dick's Sporting Goods to Delta Airlines, CEOs are rejecting those who say there's nothing we can do. I applaud them for leading corporate social responsibility and to help save lives and prevent gun violence in the future. Now, like Congresswoman Maloney mentioned earlier, I'd also like to talk a little bit about Citigroup. After the tragedy at Parkland a few weeks ago, Citi announced the new gun policies for their financial partners to require background checks and prohibit guns for teenagers. I know that you're familiar with those guidelines. It is reported that in April, a Republican member of the SEC, Michael Piwowar, threatened Citigroup, saying that because of their private gun policies, the bank lacked support for their agenda at the SEC. Now, Republicans and Democrats can agree that no regulated entity like Citibank should be punished at the SEC. So I have a couple of questions, Mr. Chairman. Have you ever been contacted by anyone at the NRA about Citi or Bank of America gun policies?
No.
Never.
In contact, well,
in regards to this specific policy, that somebody will be punished if they follow some sort of background checks on their policies?
No.
Okay. Have you ever spoken with Citigroup or Bank of America about their gun policies?
No.
Okay, and have you ever discussed any company gun policies with the SEC staff?
Not that I recall.
So you've never had any sort of conversation in regards to any gun policies with any of these entities?
No, I'm thinking because, you know, people have disclosure, they make disclosures, but have I, what, are you asking, like, gun policy in terms of SEC policy vis-a-vis gun policy?
Absolutely.
No.
Yes.
No.
Again, as I stated before, a Republican member of the SEC, Michael P. Ward, threatened Citigroup. This is back in April, saying that because of their private gun policies, that the bank could lack support for their agenda at the SEC. Not only is that unethical, that's illegal. And so I'm asking you as a chairman,
So look, I'm
if
not.
you have ever had that type of
that specific-
conversation.
That report and that incident, I'm not going to discuss that. That's been the subject raised before, and as I said, the question of whether there should be an investigation is on the table, and it's inappropriate for me to discuss anything related to that subject, but as far as your other questions to me,
So let me ask you this. Are you aware of the gun policies? The
Yeah,
new
I mean,
implemented gun policies?
When you say the gun policies, you mean the policies that private companies have adopted?
Correct.
Yeah, I'm aware of them.
Okay. Now, do you believe that commissioners and staff should require greater ethics training to prevent this type of conflict of interest from happening in the future?
I think that touches on what we talked about. I'm not going to comment on that in this forum at this time.
Okay. And now, I understand that an IG investigation has been requested. Will you agree to fully cooperate with this investigation?
I always cooperate with the IG investigations.
Thank you, Mr. Chairman. So lastly, just want to, again, thank you for being here. Thank you for being so patient with all of us. Now, I hope that this is addressed and that our regulatory agencies, including the SEC, are not threatening private companies on behalf of the NRA or any other special interest group. Because again, as I said, it's not only unethical, but it's also illegal. Thank you, Mr. Chairman. I yield the remaining balance of my time.
Gentleman from Nevada yields the balance of his time. That concludes our hearing. I want to thank the patience, as the gentleman from Nevada noted, of our witness and appreciate his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I ask our witness to please respond promptly as you are able. The hearing is adjourned.